Economists are warning that newly imposed tariffs could prevent consumers from experiencing relief from high borrowing costs this year. President Trump's decision to impose tariffs on the U.S.'s largest trading partners, including 25% on imports from Canada and Mexico and 10% on China, is expected to drive up prices for American consumers. This inflationary pressure, at a time when inflation has not yet fallen back to the target, may cause the Federal Reserve to halt its campaign to lower interest rates. The Fed's benchmark interest rate directly influences consumer borrowing costs on credit cards and other debts. While the situation remains fluid, the potential long-term impact of these tariffs on Canada, China, and Mexico is estimated to increase U.S. inflation by 0.5 to 1 percentage points through 2026, according to J.P. Morgan Private Bank. These estimates focus on core prices, excluding energy and food costs, as measured by the Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge. Evercore ISI projects that these tariffs would increase PCE inflation by roughly 0.7 percentage points, relative to a no-tariff baseline, to around 2.8% in the fourth quarter of 2025. This could eliminate at least one, and possibly both, of the remaining Fed rate cuts planned for this year. Despite some suggestions that tariffs may prompt the central bank to raise interest rates again, Capital Economics believes this is unlikely. They argue that tariffs would likely act as a drag on the U.S. economy. Similarly, J.P. Morgan projects that the proposed tariffs could reduce U.S. gross domestic product by 0.5 to 1 percentage point through 2026. This economic drag could potentially outweigh the inflationary impact of tariffs, eventually leading the Fed to cut rates.